And welcome back to another podcast with Mr. Hagan. On this podcast, we're going to do one more example of shifting curves in the aggregate demand, long-run aggregate supply model. So my real-world event this time, I'm going to do a real-world event from the past. So let's say back in 1929, we had an 89% collapse. An 89% decrease in the price of stocks. 89% decrease in the stock market. Okay, so that's a huge decrease in the price of stocks, and then we got to say what's going to happen to the economy as a result. So here we were in a classical model, long-run aggregate supply curve, aggregate demand curve, and here's my price level, here's my real gross domestic product, and my determinant is this 89% decrease in the stock market. So that's my real-world event. My determinant, I'm going to argue, I would look at the aggregate demand determinants, I would look at the aggregate supply determinants. You have a list of those. I'm going to say that it's going to be a change in consumption wealth. A change in consumption wealth. So when the stock market crashes, people's wealth is going to go down, and as a result of that, they're going to decrease consumption, and that's going to cause the aggregate demand curve. Sorry, it's not going to shift to the right. That's going to cause the aggregate demand curve to shift into the left. So that's going to cause the aggregate demand curve to shift into the left. People are going to reduce the amount of consumption that they are willing to engage in. So the aggregate demand curve is going to shift into the left, and so we're going to kind of move from this point to this point. I mean, in the long run, we can see, I'll come back to that here in a second. In the long run, we can see, we can see that prices will decline, but gross domestic product and unemployment will not change, and I need to explain that a little bit. So for the classical economist, that's going to cause a decrease in price. Why? Gross domestic product is going to remain unchanged, and unemployment is going to remain unchanged in the long run. But let's see what happens. Let's kind of think about the short run here for a second. I mean, we can't quite yet because we have to add another curve to this to really talk about the Keynesian idea. But let's just get a feel for Keynesian idea here for a second. So a Keynesian might say, okay, yes, in the long run this is true, but in the short run, that aggregate demand curve shifts into the left. As a result, right here it is, that aggregate demand curve is going to shift into the left, and as it shifts into the left, that's going to cause the gross domestic product to decline. So they would say that you're going to get this is a result of a decrease in consumption, and that's going to cause a decrease in the gross domestic product. Because remember, the gross domestic product is C plus I plus G plus NX. So if we get a decrease in consumption due to the collapse of wealth, that's going to cause the real gross domestic product to go down as that curve shifts into the left. However, the classical economist says, but wait a minute, when consumption goes down, people start buying less stuff, that's going to cause prices to fall. And as prices go down, well, that's going to cause the three things that we've been talking about, the wealth effect, the interest rate effect, and the international trade effect are all going to kick in, and we talked about these on a previous video. So now we would say this: as those prices begin to decline, as consumption goes down, prices are going to begin to fall, and as prices go down, that's going to cause my real wealth at least to kind of come back a little bit, increase a little bit, offsetting the original decline, and that'll cause increased consumption. It won't be enough to offset this original decrease, but it'll help. And the interest rate effect, as prices go down, I won't have to hold as much money in my hands to go to the store. I can afford the same stuff I bought before with less money. So that means I can save more. That'll increase savings, and that will therefore lower interest rates, and lower interest rates will increase investment. So consumption will start to go back up, investment will start to go up, and then the international trade effect is our goods will become cheaper to the rest of the world, and that'll cause our exports to go up, which will cause our net exports to go up, and eventually that will increase the gross domestic product, move us back along this aggregate demand curve as prices are going down, and get us back to our original gross domestic product. See, so really what's happening here is the classical economists are really saying, hey, even if the stock market declines, the market is the macroeconomy is going to fix itself. That original decrease in consumption will put into motion lower prices, and the lower prices will encourage more consumption, more investment, more net exports, and that'll move us along the aggregate demand curve and cause the gross domestic product to go back up. You see, this is that argument that the classical economists make, that the economy fixes itself. The economy fixes itself. It will, if you knock it out of equilibrium, it will return to that long-run equilibrium. The Keynesians are going to disagree with that, but we will make their arguments in a future video. So, big idea, real world event, determinant, shift the curve. For the classical economists, it's always going to be the price level that's going to change in response in the long run. Of course, the question is the long run. How long does this process take? That's up for debate. How long does it take the economy to get back to this equilibrium? But just know that the classical economists believe that it will. If you just let it alone, it will return to equilibrium. All natural forces will get us there. All right, this has been another video with Mr. Hagan. Thanks for joining me, and we'll see you on our next podcast.